So maybe just one point of order that I wanted to bring up. A few people have emailed me about the extra credit because it's confusing, and the reason it's confusing is because Canvas doesn't have a true extra credit setting. Like I can't just make a category extra credit. And so if you look, then all the categories add up to 101%. And so if you had grades in each of the categories, because what it does is really it takes your average grade in each category, so assignments, quizzes, exams, and then it multiplies that average grade by a factor that's based on the percentage of the total grade, so 0.5 if it's worth 50% of the total grade. So because the final exam grade doesn't have a grade yet, there's no factor there for that. So it looks like the extra credit assignment can actually be hurting your grade because theoretically it can be at this stage, but if you have a grade in every section, then it won't be because it's the extra 1%. So now, so your grade's based out of 100%, 90% out of 100% is an A-, even though you could possibly have 101%. So the short answer is extra credit will not hurt your grade if, say, you did half of it or something like that. All it can do is increase your grade, and statutorily, it's not really a statute, but it's an accounting department rule. I can't give more than 1% of the total grade in extra credit. And so it's really only enough to give you that little bump. It's not a huge amount. Anyway, so I wanted to kind of throw that out there because, like I said, I get emails saying, is it already factored in? And the answer is yes, but not really, because it won't show up. It's showing up in there, but it's not going to do its magical 1% over until all categories have a grade in them. You can go to the grade book and you can do what if scores. You could put in, what if I get a 60% on the final, and see what your final grade would be. I recommend that to people when they have multiple finals and they're trying to figure out how much. Like I had a student today that if they get a 10% on the final, they'll earn a C-, so they'll pass the class. And because they have several other stressful finals, they're like, I might be good with that. Like I might just be, I'd be happy to just not study for the final. I know I'll get a 40% or something, but that's enough to give me that C- or C that I need. For other people though, it might just create stress knowing that you have to get the best score of your life to get that grade you want or whatever. But the what if analysis is a pretty cool little tool in the grades. So really, I wanted to reserve this class for two things: answering any questions about the current stuff, this week's work, and then maybe a review of some of the final exam. You have the review, you have the checklist, and I was looking at that checklist and comparing it to the questions on the final, which I don't write, so I just had to go look at what was in there. And again, it's very close. Again, it looks like someone wrote that checklist as they were looking at the final. Which I know means something, but not everything, because you could have a good idea of what's on there and still struggle with some of those questions the way they're written. So anyway, and also recognize, and it tells you this in the checklist, but there's 70 questions on the final, and the first 15 of them cover the statement of cash flows. So this chapter that you're working on this week. And then the remaining 55 are in essence like 5 questions from each chapter. That's the way it's structured. And I'm not telling you anything that's not on the exam checklist, but so statement of cash flows features heavily because you haven't been tested on it yet. Okay, so that's my little part. So questions either, well, let's start with on this week's work, either like a problem you want to look at or just questions about this chapter in general.
Maybe you're going to cover it anyway, and I don't know if it's a learning disability I didn't know I had till my 60s or the stress of the end of school, but I cannot totally comprehend what goes in and what goes out in statement of cash flows. I understand cash in and cash out, but when it's out and it's a positive and it's in and it's a negative, do you have a simplified way of explaining that?
Maybe. So we're talking. So I'm guessing you're talking about like when you're making the adjustments, and especially in the operating activities section,
Right.
how do you know what you're doing there, because it's confusing. So recognize when you're doing a statement of cash flows by the indirect method, you always start with the net income, right? The thing with net income, though, is your net income is your revenue minus your expenses. So we know that that some of our expenses are non-cash expenses. For example, depreciation expense, right? When we take depreciation expense, we did that by, when we purchased an asset, we divided its useful life by its depreciable value, and then we take that expense each year, regardless of, there's no cash going out there. The cash all went out when we bought the asset a long time ago. So my way of breaking it down is I start with net income, and then next I subtract out non-cash expenses, which is almost always the only one we're dealing with is depreciation expense. So start with net income, subtract out the depreciation expense. The reason we're subtracting it is because that's an expense that lowered the net income, but didn't actually cost us any cash. Okay. Then I have to make my adjustments, and my adjustments are for changes in current assets and current liabilities. And so the adjustments work this way: for any changes in current assets, and we're not counting cash in that, even though cash is a current asset, but we don't make an adjustment for cash. So most often that's like our prepaid items, our inventory, our accounts receivable. Okay, those are our current assets. The adjustment is always going to be an opposite or an inverse adjustment, meaning if the current asset increased, then we're going to adjust cash down. And if the current asset decreased, then we're going to adjust cash up. So there's that inverse relationship. The reason for that is if my asset increases, I had to pay for an asset with something, and that the presumption is that it's cash. So if a current asset increases, we do an adjustment down to cash. Then we do adjustments for changes in current liabilities. If our current liability, and so that relationship is going to be the same relationship. If the current liability goes up, then we're going to adjust cash up. If the current liability goes down, then we're going to adjust cash down. So for me, if I break it into those steps, it's a lot easier. And especially because sometimes the logic behind why do I adjust up if the current asset went down can lose me if I try to like talk about it too much. But if I remember the rule and follow the rule, I can still get it. And then after you work with it for a long time, if you end up doing a job where you're actually creating statements of cash flow by hand, which nobody does anymore because computers do that for us. But if you were doing that, you would start to, honestly, the job where you're most likely to get a really good understanding of it is if you have to teach it for years and years. Then you start to see the relationship between those accounts and cash. But anyway, so that was like a really long answer, Cheryl. I don't know if it helped or it clarified anything.
Oh, absolutely. I mean, that's what I had on this side of my brain. And then every time I'd look at a problem, it just got all jumbled and I wasn't quite sure what was going on. So that really helps. I appreciate it.
So the one other thing that maybe consider is if there are non-operating revenues or expenses, you'll see that down in the other income and expense category on a classified income statement, the more detailed one.
Right.
Then we have to take those out as well because they're going to show up in other sections. So for example, if a company were to sell off a piece of equipment and have a loss of $10,000 on that sale of the equipment, well, that $10,000 is going to that loss on sale of equipment is going to impact the net income. So, but it's not part of the operating activities, right? If I sell a piece of equipment that I'm not in the business of normally selling, it's just an old piece of equipment that maybe I replaced. So any non-operating revenues or expenses, and those are in the other income and expense. So really just any other income or expense, other incomes have to be subtracted out of that net income and other expenses have to be added back in. So what we're trying to do is we're trying to take the income statement and then adjust it for all these things so that we can see how much cash we actually either gained or lost. If you think about it, you can run a business that has a loss, meaning a net loss, meaning you had more expenses than you had revenue, but because of borrowing, you actually had a positive cash flow. You borrowed, you lost $10,000, but you borrowed $30,000. So at the end of the year, you have $20,000 more cash. If you think about like tech companies, they do that all the time. A lot of times for the first several years, they'll actually make a loss, but they'll bring in money through issuing a stock. And so they'll end up with positive cash flow. And then the opposite can happen where you have a really profitable business. Let's say they're paying off a bunch of debt or something like that. So they'll have positive cash flows in the operating section, but then in the investing section, they're paying off, not investing, sorry, in the financing section, they're paying off a bunch of debt, and they end up with a negative total overall cash flow. So, and if you think about it, like the way a business works, if you have more expenses than you have revenue, so a net loss, you could do that indefinitely if you continue to borrow money, but eventually no one's going to loan you money if you keep losing. And so the income statement is kind of like, and the balance sheet together are kind of like, I always say that it's like a cancer screening. It's like you're viewing issues that if you don't resolve them in the next several years, it could kill the business. So that it gives you this sort of long view picture. But the cash flow statement is you're looking at issues that if you don't resolve them, they could kill you immediately, right? If you don't have enough to make payroll next month because of negative cash flow, then the business could be done right then and there. And so that's why all these statements are so important, and it's so important that you take them together as a whole, so that you can address things like, I'm not going to have enough money to pay my suppliers. Anyway, I could tell other stories. I worked with a business here in town that got themselves in trouble doing roofing, waiting for insurance payments. In the meantime, they can't pay their suppliers. And so even though they've done more revenue this year than they've done in years, they don't have cash enough to pay their people or their suppliers. It happens all the time.
We own a small business, so I understand that aspect of it.
People are like, you must be rich. And you're like, no, yeah. I own a storage business. So I mean, my accounts receivable is probably 30% of an annual revenue. People, because I don't like to auction on their stuff unless they I know they're not going to pay, and so I let it sit, and pretty soon they owe $1,000, and it was only $40 a month, so that's 2 years worth of their pay. Anyway, yeah, that's business. Start a business, they said. It'll be fun, right?
I never recommend it.
Add to the coast, we'll have a few laughs. Yeah.
Right. Well, that's why I have a side job where I know the same paychecks coming in every week. Like that helps. Okay, so that was a really long answer. Any other questions I can talk about for 5 minutes longer than necessary? Okay. So do you want me to kind of go over some items that I noticed on the final that may be helpful? Because that was the other thing I wanted to accomplish in this meeting. So pointedly, I'm not sharing my screen with you because I'm looking at the final, and because I kind of marked out a few that I thought would be worth, I guess, discussing the concept of it. I know, I wish I could just show everybody. I've never been good at, secrets or surprises. Let's see. All right. So like I said, the first 15 questions all have to do with this chapter that you're on right now. And again, I'm not telling you any secrets. That's in there. So, you have to understand all of these kind of, okay, so and again, this is on the little study sheet, the little exam checklist, is like, it's really important that you know the difference between operating activities, investing activities, and financing activities, and which things fall into those categories. So recognize that operating activities are those activities that you do as your normal course of business. It's the buying and selling of whatever you normally buy or sell. So for my business, that's the renting of storage sheds, right? I rent out storage lockers, storage sheds to people. So any revenue I bring in from doing that, or I should say any cash I bring in from doing that. So cash received from my customers, and any cash I pay out. So cash paid out to my suppliers, cash paid out for any expenses, utilities, and so forth. Those are going to be my cash flows from operating activities. Cash brought in from customers, cash paid out to suppliers, and other expenses. And then investing activities, it sounds like I'm buying stock, but really what I mean when I say investing activities is I mean the purchase or sale of long-term assets. So if I buy or build a new building, that's cash flow from an investing activity. If I buy or sell land, those sorts of things, those are investing activities. And then finally, financing activities are anytime I'm getting money or paying it off, so raising money. So issuing stock or borrowing money, those are all considered financing activities. Or if I pay off a loan, or if I buy back stock, those would be negative cash flows from financing activities. So most often what you'll see is the operating activities section can be negative or positive depending on the business. But investing activities is usually negative because it involves buying up assets, and financing activities is usually positive. So that's kind of the norm. And that's a really important thing to understand, those three things for this final. There's like more than one question that having a good understanding of that will help you. Any questions or thoughts about that?
I have a question I think it was on the quiz. Is that okay to talk about a question that came up on the quiz?
Sure.
And I don't remember exactly, but it had to do with a mortgage of, I believe, a building. I can't remember, and where that would go in terms of the, what category. And I thought it was in investing, but it wasn't. I think it was paying off a mortgage, I think is what it was.
Right. So mortgages are a form of financing. Okay, it's a loan, and so anything to do with a mortgage, if you borrow money on a mortgage, so what's going to happen is, let's say I buy a building on with a mortgage. So I'm going to adjust that. So I'm going to show a positive cash flow through the borrowing. That'll be in my financing activities, and I'm going to show a negative cash flow for purchasing the building in my investing activities, and those two will kind of wash each other out. Anyway, so just recognize any mortgages or other loans or the issuance of stock, those are all financing activities.
Financing, not investing.
Correct. Investing would
Okay.
be the purchase of the building.
I think it was. I almost want to say it was operating expense or operating activity was the answer, and I could be wrong, but I know whatever the answer was surprised me.
And there's an exception too. I should say, so changes in, when I say liabilities, I mean long-term liabilities. Changes in current liabilities, we are doing that as part of the operating section. Because if you think about it, the current liabilities are usually our accounts payable. Those are payments to suppliers, or unearned revenue, which is payments received from customers, right, but that we haven't earned yet. And so when we talk about operating activities, we're talking about current assets and current liabilities, and those changes are part of our adjustments to those. Whereas long-term liabilities and long-term assets, those are related to usually the other investing or financing.
Maybe that's what it was. Maybe it was a short-term note. I know the word mortgage was in there. So if you
mortgages are almost never short-term, right? I mean, that's not the nature of a mortgage.
Yeah, that's what confused me. But if it were, say, a note, as opposed to a mortgage, if it were like a 9-month note, then that would fall under operating activities. if you paid it off. It was something that had been paid off.
I'd have to see the question. I'm not sure exactly what, I don't want to give you a set answer.
Well, it's too late now, but
Right.
I was curious about it. Okay, thank you. I appreciate it.
Let's see. So let me see if there's anything else here on that topic. So for example, if we paid off long-term debt, like a mortgage, we would say that that would be recorded in the financing activities section. Okay. But any interest that we pay is part of our operating expenses. So that's another thing. So our operating activities. So that's probably a good one to make a note of. Interest is considered part of operating, right? And the reason is, if you think about it, even if it's a long-term note, the interest we pay, we record as an expense now. So just maybe remember that point, that interest expenses go in the operating activities section. If we issue common stock, that's a financing activity. That's bringing in money by selling off a portion of the company.
There was, when I was doing the homework, when I was categorizing them, I mean, I used all my 3 tries, but the one I got wrong was receipt of dividends on investment stock. Could you, I think it's supposed to be operating activities.
Okay, yeah. So if we receive dividends, that's money that we've, I'd have to look at that too, because, but so if we receive so it's one thing to pay a dividend, okay? So paying a dividend is a negative cash flow that goes along with financing, with raising money by issuing stock. So the payment of a dividend, that is part of our financing activities. But the receipt of a dividend, so if I invest in another company, that's going to be handled a lot. If you think about it, it's a lot like earning interest on loaning money to somebody. So we're going to call that part of our operating cash flows.
Hey, I've got a question on that though. I thought that would be investing, because that would be a cash inflow from investing. It's not.
No. So if I sell an investment, that's a cash flow from investing. But dividends earned on investments, think about it this way. Maybe this is a good analogy, or maybe it's not. So for me, I'll buy a building, okay? And I pay for that building, and that's an investing cash flow. It's a negative cash flow because I purchased a building. But then that building is earning me money every month. And that money I'm earning is part of my operating cash flows. Even though I'm earning it on an asset that's long-term in nature, it's that monthly sort of income from it that's the whole reason I invested in it. And so similarly, if I were to invest in a stock of another company, I might call that an investing activity, but any income I'm making from it is going to go into the operating section. Does that make sense?
No, but I get it.
If you bought a milk cow, just tease it. That would be an investment, but the milk it gives you every month, that's part of your operating activities. You didn't think my milk cow analogy was good?
That's an excellent analogy. I
got like deadpan from everyone. So apparently that was, I've had better. Anyway.
I'm lactose intolerant, so it doesn't affect me.
I'm dad joke intolerant, so I get it.
Yeah. I can take even a good learning opportunity and turn it into a bad dad joke, apparently. You have 8 kids, that becomes your one true talent. Let's see. Fixing bikes, things like that. Those are dad talents. We just stopped getting bikes. We have too many thorns here. We call them stickers in Arizona. I don't know what you call them where you're at, but that's what a thorn that pops your tire is. Okay. And again, so again, I just get comfortable with it because, like I said, it's the first 15 questions of the test. And then, let's see. So I think a couple areas that you could study that will help you on multiple questions or that you could review. And one is adjusting entries from way back in, it was either chapter 3 or 4. I think people tried to forget that exam 2 as soon as they got done with it. And so remember, an adjusting entry are those entries at the end of the period where we're recognizing either revenues we've earned during the period and have not yet recognized them, or we're recognizing expenses we've incurred. And so you'll get a lot of questions that will sort of masquerade as questions from other chapters, but are really adjusting entry questions. For example, on the last exam, there was a couple questions actually about, a company issuing a note, and then at the end of the year, what entry do they enter? And so you had to figure out, oh yeah, this note has, or maybe it wasn't issuing a note, but it was borrowing the money. I guess that's issuing the note. Anyway, sorry. So they get to the end of the year and they have to say, hey, this is a 9-month note. I won't be paying the interest until 3 months into next year, but I've incurred 6 months worth of interest in this year. And so you have to take the face value of the note times 6% times 6/12 to figure out how much interest they've incurred, do interest expense and interest payable as your adjusting entry, right? So recognize that with adjusting entries, you never have cash. It's always an expense or a revenue. And so I would review that. It's one of those concepts that came up early in the course that has kept on giving, I guess. And that some people just took it in stride and it was fine, but other people, it really trips them up still. So it's worth checking out adjusting entries. And then a couple more items here. I gotta go back to here. Sorry. My computer's getting slow. It's frozen up.
Are you able to answer a question while you're waiting?
Sure.
Since I totally bombed this last exam, I have a great fear of the bonds and stocks questions. Any helpful hints?
Well, without knowing specifically what your fear is,
The whole thing.
First of all, the recognition of the inverse relationship between bond, so the face rate of the bond and the market rate of interest and the price of the bond, right? So just always remember this: as the market interest rates go up, the price of bonds goes down. So it'll say something like, you'll get a test question that'll be something like, if the market rate of interest is 8% and the stated rate of the bond is 6%, the bond will be issued at a blank, right? And the answer is discount, because as the market rate goes up, the price of the bond goes down. And then if market rates go down, then the price of the bond goes up. So that inverse, locking that in helps conceptually with a whole kind of slew of questions about bonds. Secondly, when it comes to stock questions, remember that the common stock account always shows the par value of the shares of stock that were issued, regardless of what the market price of the stock does, regardless of whether or not we've purchased stock back into treasury stock. So if